What would be your response to the question, why should I hire a financial advisor when I can do it all myself? Advisors are expensive. V, grow and chill. I can handle my finances myself. Why should I pay an advisor at all? Advice won't make a big difference. These are actual responses from people I've talked to over the years. Many of them wound up becoming clients of mine. Later in this video, I'm going to show you the math on how advisors can potentially add 3% above and beyond your investment returns. Let's take a closer look. Today, we're diving into a game-changing report that's got the investment world buzzing. It's called Advisors Alpha from Vanguard, and it might just change how you think about the value of financial advice. Now, I know what you're thinking. Harry, isn't Vanguard all about low-cost index funds and DIY investing? You're completely right. But stick with me, because this report has some surprising insights that even the most passionate DIY investor should know about. First off, let's talk about what alpha means in the investing world. It's basically the extra return an investment strategy generates compared to the market average. Traditionally, advisors have tried to prove their worth by beating the market. And as I'll report in a future video, beating the market, especially in the US, is all but impossible for active investors. Here's where Advisors Alpha comes in. According to the reports, the real value of a financial advisor isn't just in investment selection. Instead, it's in 7 key areas that can potentially add up to 3% in net returns for clients. Yes, you heard that right, 3% per year added to your returns. Let's address the elephant in the room. You've probably seen countless YouTube videos from finfluencers claiming that financial advisors are a complete waste of money. In fact, in my last video, I helped break down what Ramit Sethi said about the subject. Finfluencers will tell you to buy some index funds and call it a day. And hey, for some people, that might be more than enough. But here's the thing. To get that extra 3% per year, you need financial planning. And proper financial planning involves significantly more than just stock selection. Financial planning is about behavioral coaching, tax efficiency, estate planning, and a whole lot more. That's where Vanguard highlights how advisors can really shine. So let's break down these 7 areas. Number 1 is asset allocation. This is about finding the right mix of stocks, bonds, and other investments for your specific situation. Vanguard says this adds value, but it's hard to put an exact number on it because it's so personal. For example, a 20-year-old has a far different investment mix than a retiree. Person by person, this will add value, but of course it's hard to measure. Number 2 is cost-effective implementation. This is fancy talk for using low-cost funds. Vanguard estimates this can add about 0.3% in returns annually. This is where finfluencers actually can add value. By selecting low-cost funds, your likelihood of achieving the benchmark returns is higher. Number 3 is rebalancing. This is regularly adjusting your portfolio to maintain your target asset allocation. In theory, this sounds simple, but in practice, it's difficult to do systematically. If you do rebalance regularly, this could add about 14 basis points to your returns each year. Number 4 is behavioral coaching. This is the big one, folks. Vanguard estimates this could add up to 2% in annual returns by preventing you from making emotional decisions during market ups and downs. We'll talk about this later in the video, but imagine, just by taking care of your psychology, you can add 2% every year to your returns. That's massive. Number 5 is asset location. This is about putting the right investments in the right accounts to minimize taxes and maximize total return. Doing so could add up to 0.6% in annual returns. Number 6 is spending strategy. Having a smart plan for withdrawing money in retirement. This could also add up to 1.2% in returns too. Number 7, total return versus income investing. This is about focusing on overall returns rather than just dividend income. Many of you might see a high yield on a stock, but that ignores the price return that you might get from a better, less dividend-paying stock. Like asset allocation, this is a unique blend for each investor, and the value can only be quantified person by person. With those 7 factors, Vanguard estimates an advised client may earn 3% per year above their non-advised peers. Now, you might be thinking at this point, Harry, this all sounds great, but aren't you trying to just justify paying higher fees? It's a fair question. In fact, I agree. I'm speaking here and trying to justify to you all that advisor fees like mine are worth it, even though we're likely to be 1 to 1.5% on top of your ETF costs. Here's the kicker. Vanguard isn't saying all advisors provide this value. They're saying advisors who provide these best practices can potentially add this much value. So how can you find if your advisor practices these 7 steps, let alone even knows of them in the first place? First, you want to ask them if they've heard of this report. Next, ask them what their investment philosophy is. To learn more about how I invest for my clients, hit subscribe to be notified of my next video on my investment philosophy. If you don't have an advisor, ask yourself, when have you researched behavioral coaching or studied investor psychology? Or better yet, ask yourself what you did in the last market crash, or what you thought of the latest Bitcoin, Nvidia, or tech mania. Did you have FOMO, or were you okay sticking to your plan? So how does this compare to what finfluencers are saying? Well, many popular finance YouTubers focus heavily on DIY investing and avoiding fees at all costs. They promote that advisors provide zero value, and you should just buy the S&P and walk away. Well, they're not wrong that high fees eat into your returns, but what they often overlook is the psychological and tactical aspects of financial planning and how that adds significant value. Let's be real. How many of us can honestly say we didn't feel the urge to sell everything during the early days of the COVID crash in 2020? Or jump headfirst into meme stocks when they were all over the news just a few months later? An advisor's job isn't to just pick investments. It's to be a voice of reason when rational behavior goes out the window. But here's where I actually agree with finfluencers. Not all advisors are created equal. If you're paying 1% or more in fees to advisors just putting you in their hot stock portfolio and then never calling you again, you might want to reconsider that relationship. The key takeaway from Vanguard's report is that advisor value goes way beyond just investment selection. It's about comprehensive financial planning, tax strategy, behavioral coaching, and way more. If your advisor already takes care of these, you're likely far ahead from your DIY peers. So what does this mean for you? Well, if you're watching this video and you're confident in your ability to handle all aspects of your financial life, from investment selection to tax planning and estate management, and you know that you won't panic sell during the next market crash, then maybe the DIY approach is right for you. But if you find that you don't want to manage your finances in the first place, you're too busy, or you know that you might make emotional decisions during market turbulence, as one example, then working with a qualified advisor could potentially add significant value. Even if you do prefer DIY investing, maybe it makes sense to have a larger portion managed by an advisor where you have your own smaller portfolio on the side. Remember, the goal isn't only to beat the market at all costs. It's to reach your financial goals with the least amount of risk. And sometimes having a guide along the way can make all the difference.